Hello and welcome to Commodity Culture, where we break down the commodity space for both new and experienced investors. My name is Jesse Day. Before we get started, standard disclaimer: nothing here is investment advice. Do your own due diligence. And today's episode is brought to you by moneymetals.com, the most trusted online bullion dealer and depository in the United States. Use Money Metals for purchasing, selling, or storing physical gold and silver. Hit the link in the description below to learn more and use coupon code JesseDay to get a $10 discount on your first purchase. Today's guest is a professor of applied economics at Johns Hopkins University, a senior fellow at the Independent Institute, and is ranked as the world's third most influential economics influencer by Focus Economics. Steve Hanke, it's an honor to have you on the show.
Great to be with you, Jesse.
As you are a new guest on the show, we always like to start with the origin story. So tell us how you first discovered economics and financial markets, and how did that road lead you to where you are today?
Well, this goes way back. I grew up in rural Iowa, and of course, in rural Iowa, that's a big agricultural center, as you know. So everyone's buying and selling all the time: cattle, hogs, corn, soybeans, oats, hay, land. You you name it. They're just markets all over the place. The big central market for livestock was, of course, Omaha and Chicago in those days. Uh, and about 70 years ago, I actually started trading. I said it was a long time ago. That's 70 years. That's older than you are, Jesse. So I've been trading. I've been around trading for a long time. My grandfather had a big egg candling operation, and what that involved was collecting eggs from the farms, bringing those in central processing operation, and grading them, candling them, making certain they were okay, packaging them up, and then they would put them into cold storage until you accumulated enough eggs for a big semi load to go back to the East Coast, mainly to New York, sometimes to Boston. But that took a long time. And in the meantime, the price could go down. It could go up also. And if my grandfather didn't want to be enduring the price risk, he would sell those eggs forward on with a futures contract on the Chicago Mercantile Exchange. That egg contract doesn't exist anymore, but 70 years ago it did. And if you sold the eggs forward, of course you knew what the price was, so you avoided the price risk. So this is a standard hedging kind of operation on a forward market. Actually, it was a futures market. So that was kind of the first formal thing, and then when I was about 14 years of age, 4 years later, I did open my own trading account and started trading. In those days, I was trading soybeans. And then there was kind of a lapse. I went off to the university and finished my undergraduate and graduate work. And at my first teaching opportunity or position I had was as a professor at the Colorado School of Mines. Now, of course, you're involved with oil, gas, and minerals mining there. So you're in markets, and I taught the first course there in petroleum economics and mineral economics, but what wasn't really actively trading. And then I came to Johns Hopkins University. I'm in my 54th year at Johns Hopkins, but in the meantime, I had other positions simultaneously, and one of those was uh, starting as a chief economist at the Friedberg Mercantile Group in Toronto. And we're commodity and foreign exchange traders. I'm chairman emeritus at Friedberg's now. But in 1985, when I joined Friedberg's as a chief economist, I developed a simple little plain vanilla model of OPEC, And the conclusion was that OPEC was going to collapse, and that the price of oil would go down below $10 a barrel. So, which ultimately it did. We had big short positions. We actually had, looking back on it, we had about 70% of all the short interest in the gas oil contract in London. So we had huge positions, and we also were short the Saudi rial and Kuwaiti dinar at that time. So that was a big deal. It was a very profitable big trade. And then in 1993, I concluded that the French franc was in big trouble. They were in the uh, ERM at the time, and we took a big short position in the franc. Then it was called the Frankfurt in English, and we almost blew the thing out of the Frankfurt. We even made it to the French article in the French weekly Paris Match. And then 1998 rolled around, and I gave a speech in Vienna, and I think it was in February of 1998, and I mentioned that the net foreign assets at the Russian central bank were falling like a stone, and they were being replaced by a huge increase in net domestic assets, and that in short the backing for the ruble was disintegrating, and I thought the ruble would get into trouble, and there happened to be a Reuters reporter listening to that speech, and he put what I had to say out on the wire, and the ruble sank about 3% against the dollar immediately when that hit the wire, and I knew I was onto something. So we had big short positions on the ruble, and as you know, the ruble collapsed in August of 1998. It was a big deal. Remember, long-term capital went bankrupt, uh, and all sorts of things. So that was 98. Backing up, by the way, to 95, I was president of Toronto Trust Argentina in Buenos Aires, and that was the best performing mutual fund in the world in 1995. So so that gives you a little thumbnail sketch of you know overview of things.
I wanted to draw on your experience in markets to take a look at the gold market at the moment because the World Gold Council recently released their Q3 2023 report where they highlighted the fact that we've been seeing record levels of central bank gold buying this year. So I wanted to get your take. Why do you think central banks are accumulating so much gold? Is this a bullish catalyst in your view? Because some gold bugs point to the fact that, well, the smart money, the sophisticated money is now piling into gold. So that should send a signal or set an example that individuals should be following suit, or do you not see a connection there?
I'm not necessarily a gold bug. I'm interested in the gold market, obviously, and I'll get into that in just a minute. But fundamentally, I think gold looks pretty strong. From a fundamental point of view, I'm on the bullish side, and you never exactly know what these central banks are going to do, but the trend is your friend, and the trend right now is a lot of central bank buying, and the reason behind that, I think, is that there's just simply a lot of uncertainty. Everything has become more and more politicized in the realm of fiat money, shall we say, and as a result of that, the central banks are accumulating gold. They've been, you know, not big players in the market for some time, but now they are. Particularly the ones that are in this kind of de-dollarization mode. They want to lighten up on their dollar exposure because the U.S. has so politicized and weaponized the U.S. dollar with particularly sanctions. I mean, since 9/11 and the war on terrorism has started, sanctions have just gone up, 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 and now with Biden, they're really on steroids. They were going up very fast with Trump, by the way. So it's kind of a bipartisan thing. It doesn't have anything to do with political parties. It's just, I think it's utter stupidity on the part of the United States, but that's a reality. So you've got China buying big, even Poland. Poland was a big buyer in the last quarter, and the Polish officials, you know, essentially said just what I was saying. So that's the fundamentals. Now, on the short term aspect of gold, for me, of course, I'm long. That's as an investment. But now let's look at trading, because even if gold stays the same throughout the year, it's at the same price at the end of the year as the start of the year. It fluctuates around, and to pick up that fluctuation and trade on it, Abe Kaufness and I have developed something we call the Hanke Kaufness Gold Sentiment Score. And what we do every hour, we do text mining of all the articles on gold that come out, and that text mining that's done by computers determines, given a dictionary of words that we've developed, whether the article is bullish or bearish on gold. And if it's bullish, we get a high positive score. These scores go from +10 from the bullish side to -10 on the bearish side. So how do you trade on that? Well, you have to develop algorithms that are connected to the sentiment score for trading purposes. And if the sentiment score goes way positive, let's say it's +4, 5, 6, that's bullish. What you want to do is either liquidate your long position in your trade, or take on a short position, because we know that with a high probability of over 60%, that sentiment score will revert back towards neutral or bearish. It swings back and forth, back and forth. So you can be putting on, maybe even 3 trades a day. Maybe you're long, then short, then long again. And we've been doing this for a couple of years, and the performance has been quite good, in like the 30 to 40% return per annum, depending on the algorithm. It depends on the algorithm you have set up and connected to the sentiment score. So that's it on gold.
And so you're trading gold using this system strictly by sourcing keywords from all of the articles that are available online and determining if it's a bullish or bearish sentiment overall. Is there anything else involved in the process?
No, that's it. It's the only sentiment score like that in any market in the world. We're really innovating. We've been working on this for actually more than 2 years. The algorithm part and the trading has come within the last couple of years, but we started working on this quite some time ago. There's technical ways that you can look at price action and come up with a sentiment score or index based on technical factors. That people have known that for a long time, but people haven't known how to read the literature. What is actually coming out every hour, and is that article bullish or is it bearish? And then we aggregate all of the articles together to come up with kind of an aggregate, shall we say, Hanke Kaufness Gold Sentiment Score. And you can get that at www.goldreports.com. You can go to the website. If anyone's interested in it, they can go there and read all about it.
Yeah, I'll put a link in the description for sure. I'd like to pivot over to silver for a moment because Oxford Economics released a report on silver demand recently, and it estimated that the combined factors of industrial, jewelry, and silverware fabrication will increase demand by 42% between 2023 and 2033, which is roughly double silver demand over the last decade. And this isn't even factoring in investment demand at all. What are your thoughts on the findings of that report and on silver? Do you look at it as similar to gold as a monetary metal? Do you see it more as an industrial commodity at this point? What are your thoughts there?
It's still really in the industrial category, and it doesn't. Uh, it trades differently than gold. I mean, gold has an industrial component, as you know, but it also has a big financial store of value component. This huge central bank buying. I mean, how many central banks are buying silver? I mean, I don't know if any of them are, quite frankly, but uh, I don't have anything really very constructive to say. I mean, you just enunciated what one analyst has put forward, and that is bullish. But remember, the market price of something is an objective value. All these individual analyst reports, that's a subjective analysis of what some analyst thinks. And then you and I and thousands of other people take in all those subjective things, and we decide, oh, is the market price that's objective, is that above the subjective level or below? And if the market price is below where we think the subjective level is, we buy. And if it's above, we sell. So it's a, you've got one analyst, and that's what they're saying, and if we looked at all the reports, added, aggregated them, made them comparable and everything, we would come up with a subjective idea about what we thought the fair value subjectively for silver was. And if that happened to be below where Mr. Market was, that's objective, we buy.
Yeah, some very good points there. I wanted to shift to some more broad economic questions because you've noted before that politically open societies that subscribe to the rule of law, to private property, and to the market allocation of resources grow 3 times more rapidly and are 2.5 times more efficient than societies in which those freedoms are abridged. Could you break that down for us?
Well, um, I've done a lot of work on this, and there are various indices that have been constructed about economic freedom, and if you look at those, you have a lot of countries. Let's say 150 countries, and each of them have some economic freedom score that are made up of various things, and you find that there's a very high correlation. One original study that I did on this years ago, maybe 30 years ago, there was about a 1-to-1 correlation. If you the elasticity is 1, so if you increase economic freedom by 10%, economic growth increases by 10 percentage points, and vice versa. So people who have low scores don't grow very fast, they have low productivity. People who have high economic freedom scores grow pretty rapidly. And if you look at this, the easiest way to think about it, look at Europe and the United States. The economic freedom scores are lower in Europe than in the United States. That's because you have the welfare states, the government involved much more in Europe in the economies than in the United States. And if you look at starting in 1973, so what do we have? We got 50 years there, just a half a century. If we look at GDP growth, the index starting in 1973 in Europe was 250. Excuse me, it was zero. and it went up to 250. It's gone up to 250. The U.S. was zero in 1973. That index of GDP growth is 450. So you got some almost twice as much growth in the United States as you've had in Europe because of that. Productivity is even much more different. The index for productivity now today is about 50 in Europe. It's about 150 in the United States. So it's about three times higher, the productivity. So GDP growth has been about double in the United States what it has been in Europe, and productivity, about three times more rapid in the United States than it is in Europe over the last 50 years. So the proof of the pudding is in the eating. I mean, this is what the data say. You just let the data talk, and that's what they're saying. So if you want to grow, you have to liberalize the economies, become more free market.
And so it feels like Western societies in particular are getting less free than they used to be when it comes to personal freedoms, private property rights, things like that, particularly since the pandemic lockdowns. I mean, I left Canada in 2021 because of how much freedoms were being taken away. You mentioned Europe there. The EU seems to be getting more and more authoritarian with their policies. Do you agree with that view? And if so, are those nations going to lose the growth and efficiency associated with free and open societies?
Oh, they're all slowing down. The U.S. I just last Friday, Sean Tully published an article, a long interview with me in Fortune magazine. We were talking precisely about this. Industrial policy, they call it, and industrial policy is where you have the government picking winners and protecting losers with subsidies and that kind of thing. So the U.S. Has not really practiced open industrial policy, and now with the Biden administration, they've adopted explicitly as of April a speech that the National Security Advisor Jake Sullivan gave at the Brookings Institution. You can Google and find the thing easily. That lays out a new economic model for the United States, which is an industrial policy model. So that means what? The U.S. is going to copy what they're doing in Europe. I mean, and of all things, I mean, the French are even bitching about this industrial policy thing that the Biden administration is adopted. They say it's kind of over the top. So the U.S. I anticipate is going to be in for economic trouble in the long run. This this outsized increase in productivity and GDP that I've said over the last 50 years in the United States, that gap is going to narrow because the U.S. looks like it's moving in a position to kind of copy Europe, have more of a European kind of model. And this, I think, is going to end up being a disaster. It follows, by the way, logically, because U.S. sanctions are what? Sanctions mean that the government and politicians are getting in between a willing buyer and a willing seller. Well, that's sanctions. Now, what's protectionism? Protectionism is also the same thing, getting in the way politically of willing buyers and sellers. Now, if you accept that and you're comfortable with it, which the U.S. population seems to be with sanctions, because both political parties are all behind this. And Trump, by the way, who was a Republican president, he was very big on sanctions and protectionism. And now Biden is very big on sanctions. He's very big on protectionism. And he's adopted this overall industrial policy idea that just expands the scope for this kind of intervention. And and it's very much a European way of looking at the economies. some people call it interventionism. It's called industrial policy, interventionism, politicization of everything. So you can't do anything without the politicians approving or disapproving of the thing. That's basically the idea. So I, I think I think the days of Ronald Reagan, free market economics, and so forth have really the model has been tossed into the trash can of free markets, and now we've got the state being involved in virtually everything, and it comes in all kinds of things, but especially the green thing. Once you decide you're going to be green, you start adopting central planning and industrial policy, and the government knows best. Now, this is, of course, the stupidest thing. Just to think of the economic incentives. A bureaucrat is deciding, or a politician is deciding how to allocate resources. They pay no cost for any mistake they make. Now, think about the profit and loss system. If you're in a profit and loss system without the government intervening, and you make a decision about allocating capital, and it turns out to be wrong, you get your fingers burned and you don't do it again. Or you might even be bankrupt and be out of business. So the market incentives take care of allocating capital and rewarding people that wisely put capital into areas where they have high rates of return on capital, where they're satisfying consumers, supplying things at low cost that consumers want. Or if they make a mistake and they start producing things people don't want, they don't make any money. They have losses, and they get their fingers burned. But the bureaucrat never does. You're giving a lot of power to people who don't pay the cost of any mistakes that they might be making. It's the stupidest and quite frankly most dangerous way to allocate capital. I mean, remember that Beatles tune, "Back in the USSR"? That's where we're going. That's at the extreme. That's what happens. And just look at China. Look at China, for example. The China, with Deng's speech in 1979, they start opening up China and letting more decisions be made by private individuals who would be rewarded if they produced things people wanted, and they'd be penalized if they were not. And you've had the greatest growth. It's the greatest free market story in the history of man is China, and with Deng. Now Xi, of course, he wants to turn back the clock and change that and have more state control. So in a way, you see, Biden is in the U.S. They're copying Xi. That industrial policy is what they do in China now.
So, do you see any parts of the world at this point in time going in the opposite direction? Is there anywhere where markets are becoming more free?
There are no obvious ones. When I say obvious, by the way, this gets back to trading. By the way, so at Friedberg's, one thing we place big bets on are these economies where things are changing. So when the Chicago boys came into Chile in the 1970s, Pinochet was the president. We bet big on Chile. We did very well. In Argentina, by the way, when Menem was elected in 1989 and started reforming, did the convertibility system of the currency, we placed big bets on that. And I told you in 1995, Toronto Trust Argentina was the best performing mutual fund in the world. We also got into New Zealand. The Labour Party won in 1980s. David Lange won the election, And Sir Roger Douglas, with Rogernomics, he put in Rogernomics, huge free market reforms in New Zealand. We bet on the currency and the market. We did very well. So you had Chile, Argentina, New Zealand, uh, to some extent with Reagan. Of course, we had a huge rally in the dollar when Reagan came in. Thatcher in the UK, uh, and you had China. We didn't participate in that boom. It was mainly a property rights issue. So it depends. There is no big reforms on the horizon right now that I can see. Maybe I'm missing something. I don't know, but it's possible in some small country, and I'm just not up to speed on it. But I don't think there are any.
Well, you were speaking about sanctions earlier as well, and how sanctions have been increasing recently. And you have also noted recently that Russian tax revenue from oil and gas more than doubled from September to October this year, proving these sanctions and price caps on Russian energy haven't slowed them down. So I guess the question is fundamentally, why does the West insist on imposing sanctions when they're ultimately doomed to fail?
Well, they're stupid. I mean, they don't even know the scholarly literature, because the scholarly literature shows you that sanctions don't work. I mean, they're counterproductive. They produce a lot of unintended consequences. Look at Russia. Russia now is going to grow at you know a little under 2.5% per year. Look at Germany. Germany's added all these sanctions against Russia, and they're going into a deep recession. Europe's going into a huge recession because of all the sanctions, among other things, all the sanctions that they put on Russia. And Putin is even more popular than he was before the war with Ukraine, because once you put sanctions on somebody, you have a rally around the flag effect. That's why Castro stayed in power for so long. That's why Maduro in Venezuela, he's been in power 10 years, and they've had two hyperinflations in Venezuela in that 10-year period, where inflation rates have gone over 50% per month. And Maduro is still in power because of U.S. sanctions and the rally around the flag effect. What about North Korea? Got all kinds of sanctions. What about Iran? The regime's still in power in Iran. The sanctions keep them in power. So the Western politicians are literally stupid. They're very poorly advised. I have a big library, books on sanctions. They almost never work. They're just they're a fool's game, basically.
Well, I would like to get your take on the Portuguese prime minister resigning after police raided his residence in connection to alleged corruption related to lithium mining and hydrogen projects. What are the important takeaways from this story that you think people should be paying attention to?
Well, number one, we'll have to see after they investigate this what really happens. But Portugal, the 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 the, the main takeaway is that the most interesting, some of the most interesting lithium deposits in Europe are in Portugal. So that's the main takeaway. The prime ministers can come and go, but lithium's staying there. It's not going anyplace unless someone exploits it. So that's point number one. Now, as far as the government is concerned, the parliament will stay in power until the end of November, when they approve the 2024 budget, and then they're going to dissolve the parliament and have new elections. And there'll be a caretaker government until that election occurs. I think it's scheduled to occur in December. So quite a bit of uncertainty, and it looks like the socialists won't do as well as they did, obviously, in the last election. So uncertainty, probably the risk premium on bonds will be a little bit higher in Portugal than it's been as a result of that, and also uh, the, the the money coming from the EU. It comes in something, the Recovery and Resilience Facility, the RRF. So money comes from Brussels into the RRF, and there's some question about, well, is the money going to keep coming as a result? And even if it does keep coming, whether the government, with the caretaker government and so forth, will be able to allocate it uh, in a timely way. So the two issues are risk premium because of uncertainty, risk premium probably going up, bond yields going up a little bit, and what happens to these European funds that are coming in. Will they keep coming in as fast into this RRF facility? And will the government be able to expend those funds that are in the facility in a prudent, timely way? So that's basically the take on uh, Portugal. But staying away from the economics itself and getting back into my old field of expertise, mineral economics, lithium is there. It's not a hypothetical. It's there. Big time. Very very important.
Well, Steve, thank you so much for joining us today. It's been a very enlightening conversation. Before I do let you go, for those who want to learn more, can you tell us about your work at the Independent Institute? And if there's anywhere you'd like to direct people online, feel free as well.
Well, I think the one thing you mentioned, my Twitter or X account. It's at Steve underscore Hanke, and I think we have about 668,000 followers. So that's a way to keep up with things in real time with me. If you want to be added to my distribution list, you can just send me an email at hanke@jhu.edu. And if you want to go back into the archives of things, you just go to Google the Independent Institute and my name, and there's an archive of articles.
Great. Well, I'll put links to all that in the description below for people who want to check it out. Thank you once again for joining us, Steve, and sharing all your knowledge with the audience.
Okay, good. Thank you. Good to be with you, Jesse.
And thank you for joining us today. As a reminder, this episode is sponsored by moneymetals.com. Use coupon code JesseDay to get a $10 discount on your first purchase. Link is in the description below, and I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.